Hey there, fellow investors. Welcome to a journey where we demystify the world of finance and investing. Ever feel like Wall Street is speaking a different language? Like it's a secret code only a select few can crack? Like it's this exclusive club reserved for guys in fancy suits, sipping on expensive coffee and making decisions that seem out of reach for the rest of us? Well, I'm here to tell you that's a load of bull. Investing is not just for the elite, it's for everyone, including you. You don't need a fancy degree or a seat on the stock exchange floor to invest like a pro. You can do it from the comfort of your home, your favorite coffee shop, or anywhere you feel comfortable. You just need the right mindset, a little bit of knowledge, and a whole lot of common sense. It's about being curious, willing to learn, and ready to take action. And that's where Peter Lynch comes in. Lynch is not just a name, he's a legend in the world of investing. Lynch, the legendary manager of Fidelity's Magellan Fund, wrote the book on beating the street. His strategies and insights have stood the test of time, literally. It's called One Up on Wall Street, and it's chock full of wisdom for the everyday investor. It's a treasure trove of practical advice and real-world examples. Lynch believes, and I couldn't agree more, that you, yes you, have what it takes to outperform the so-called experts. You have the power to make informed decisions and achieve financial success. Why? Because you have something they don't, first-hand knowledge of the real world. You see trends, understand consumer behavior, and can spot opportunities that others might miss. Lynch's philosophy is all about empowering the individual investor. He wants to level the playing field and show you that you have the tools to succeed. He wants to show you that you don't need to be a financial whiz to make smart investment decisions. It's about using your everyday experiences to guide your investment choices. You just need to open your eyes, trust your gut, and be willing to do a little homework. It's about being observant, staying informed, and continuously learning. In this essay, we're going to break down Lynch's key principles and show you how to put them into action. We'll explore his strategies, tips, and the mindset you need to succeed. Get ready to take control of your financial future and show Wall Street what you're made of. It's time to empower yourself and make your money work for you. So, what's One Up on Wall Street all about? In a nutshell, it's a roadmap to investment success for the average Joe and Jane. Peter Lynch, the legendary investor, shares his insights and strategies in a way that's easy to understand and apply. Lynch lays out his investment philosophy in a clear, concise, and often humorous way, making it accessible to anyone who's ever wanted to take control of their finances. He demystifies the stock market, breaking down complex concepts into bite-sized, digestible pieces. He argues that individual investors actually have an advantage over the pros. Unlike professional analysts, individual investors can leverage their unique perspectives and everyday experiences to spot investment opportunities. Think about it. You're out there in the real world interacting with businesses every single day. You notice the trends, the popular products, and the bustling stores. These observations can be invaluable when it comes to making investment decisions. You see what products people are buying, what restaurants are packed, what trends are taking off. This first-hand knowledge gives you a leg up on Wall Street analysts who are often disconnected from the everyday consumer experience. Wall Street analysts are stuck in their ivory towers, crunching numbers and staring at spreadsheets. They rely heavily on data and forecasts, which can sometimes be misleading or outdated. They're so busy trying to predict the market that they miss out on what's happening right under their noses. Lynch believes that by paying attention to the world around you, you can identify promising investment opportunities before they become obvious to the professionals. Lynch encourages readers to use their everyday experiences as a springboard for investment ideas. He suggests keeping a notebook to jot down observations and potential investment ideas as you go about your daily life. Do you love a particular brand of coffee? Is there a cafe that's always packed with customers? These could be signs of a successful business worth investing in. Is there a local store that's always bustling? Are there products that you and your friends can't get enough of? These are potential investment opportunities that you can explore further. Those are potential investment opportunities. By combining your personal observations with some basic research, you can make informed investment decisions that align with your interests and experiences. One Up on Wall Street is your guide to turning your observations into profits. Lynch provides practical advice on how to evaluate companies, understand financial statements, and build a diversified portfolio. It's about ditching the complex jargon and relying on your own common sense. Lynch emphasizes the importance of understanding what you invest in and not getting swayed by market hype or fear. It's about taking ownership of your investments and building a brighter financial future for yourself. With Lynch's guidance, you can confidently navigate the stock market and achieve your financial goals. One of Lynch's most powerful concepts is surprisingly simple. Invest in what you know. Sounds pretty straightforward, right? But it's amazing how many people overlook this fundamental principle. We get caught up in chasing the latest hot stock tip or trying to decipher cryptic financial reports. We forget that some of the best investment ideas are right in front of us. Think about it, you're already an expert in something. Maybe you're a whiz at home improvement, a fashionista with an eye for the next big trend, or a tech guru who can spot a promising gadget a mile away. Whatever your passion or area of expertise, there are likely investment opportunities tied to it. Let's say you're a coffee fanatic, like me. You notice a new coffee shop popping up in your neighborhood. The place is always packed and people are raving about their lattes. You decide to do some digging. You try their coffee, delicious. Chat with the owner and find out they're planning to expand to other locations. This, my friends, is an invest in what you know moment. You've identified a promising business in an industry you understand. Now it's time to see if their stock is a worthwhile investment. Section 4: 6 Flavors of Stocks, Finding Your Investment Style. In this section, we'll explore the diverse world of stocks and help you identify which type aligns best with your investment goals and risk tolerance. Now, before you go dumping your life savings into that trendy coffee chain, let's talk about the different types of stocks out there. Understanding these categories can help you make more informed decisions and build a balanced portfolio. Lynch identifies 6 categories, each with its own set of characteristics and investment strategies. Knowing these can help you navigate the stock market with greater confidence. First, we have the slow growers. These are typically large, well-established companies that grow at a steady but unspectacular pace. They are often industry leaders with a long history of stable performance. Think blue-chip stocks or utilities. These companies are like the tortoises of the stock market, slow and steady. They're not going to make you rich quick, but they offer stability and often pay dividends. This makes them a good choice for conservative investors looking for reliable income. Next, we have the stalwarts. These are solid, reliable companies with above-average growth potential. They are often well-known brands that have a strong market presence and consistent earnings. They're not as exciting as the fast growers, but they can still deliver solid returns over time. They offer a good balance of risk and reward. Think companies like Coca-Cola or Johnson & Johnson. These are the brands you see every day, and they have a proven track record of performance. Then, there are the fast growers. These are the companies with the potential to skyrocket in value. They are often smaller, more innovative businesses in rapidly expanding industries. Think tech startups or companies with disruptive technologies. These stocks can offer substantial returns, but they also come with higher risk. They're often the darlings of the stock market, attracting a lot of attention and investment. However, their success can be volatile and unpredictable. Moving on, we have the cyclicals. These companies' fortunes are closely tied to the economic cycle. They tend to do well when the economy is booming, but struggle during downturns. Think airlines, automakers, or retailers. These industries are highly sensitive to economic conditions and consumer spending. Investing in cyclicals requires a good understanding of economic trends and timing. They can offer great returns during economic upswings, but can be risky during recessions. Next up are the asset plays. These companies have valuable assets that are not fully reflected in their stock price. This could be anything from real estate to patents to brand recognition. The key is to identify these hidden gems before the market catches on. They can offer significant upside potential if the market eventually recognizes their true value. Think of companies with valuable real estate holdings, unique patents, or strong brand equity that isn't fully appreciated by the market. And finally, we have the turnarounds. These are companies that are struggling but have the potential to bounce back. They're often considered high-risk, high-reward investments. The key is to identify companies with a solid turnaround plan and a good chance of success. This requires careful research and a keen eye for potential. Think of companies that have faced significant challenges but are showing signs of recovery. If they succeed, the rewards can be substantial. Investing in turnarounds is not for the faint of heart, but it can be incredibly rewarding if you pick the right company at the right time. So there you have it, the 6 flavors of stocks. Each type offers its own set of opportunities and risks. Understanding these categories can help you build a diversified portfolio that aligns with your investment goals and risk tolerance. Remember, the key to successful investing is not just picking the right stocks, but also understanding your own investment style and risk tolerance. By knowing the different types of stocks and how they fit into your overall strategy, you can make more informed decisions and increase your chances of success in the stock market. Section 5. The stalwart strategy, slow and steady, wins the race. Let's dive a little deeper into one of these categories. Stalwarts. Remember those solid, dependable companies we talked about? Think of them as the tortoises of the investing world. They're not flashy or exciting, but they have staying power. These are the companies that have been around for decades, weathering recessions, market crashes, and even the occasional global pandemic. Now I know what you're thinking. Jim, where's the excitement? Where's the quick buck? Look, I love a good growth story as much as the next guy, but there's something to be said for stability, especially in today's volatile market. Stalwarts are like that reliable friend you can always count on, no matter what life throws your way. Investing in stalwarts is all about playing the long game. You're not going to get rich quick with these stocks, but you can build a solid foundation for your portfolio. Over time, these companies can deliver consistent earnings growth, which translates into higher stock prices and often juicy dividends. They're not going to make you want to do a victory dance every time you check your portfolio, but they will help you sleep soundly at night. Section 6. Fast growers riding the rockets of the market. Now, if you're looking for a wild ride, fast growers are more your speed. These are the companies that are disrupting industries, innovating at lightning speed, and yes, potentially making early investors a boatload of money. We're talking about the Amazons, the Googles, the Teslas of the world, but here's the catch with fast growers. They're not for the faint of heart. These stocks can be incredibly volatile. One minute they're soaring to new heights, and the next, they're plummeting back down to earth. That's why it's crucial to do your homework and understand the risks involved before you invest. When evaluating fast growers, look for companies with a clear competitive advantage, a strong management team, and a massive potential market. You want to see evidence that their growth is sustainable and not just a flash in the pan. Remember, not every fast-growing company is going to be the next Amazon. Some will flame out, while others will get acquired or simply slow down as they mature. But for those that succeed, the rewards can be astronomical.